Borrow Smart segment brought to you by rsrhomeselect.com. RSR Home Select. Love this loan. It's the best loan on the market, bar none, because you don't have to make a loan payment on it if you don't want to, once you've got enough equity built up in your property. Tap into hidden wealth. Use how to use a HELOC, home equity line of credit, to build financial freedom and achieve your goals for homeowners and first-time buyers. Understanding how to leverage home equity can be a pivotal step toward financial empowerment. A home equity line of credit, HELOC, offers a flexible means to access funds for various needs, from home improvements to debt consolidation. This guide delves into the essentials of obtaining a HELOC, ensuring you're well prepared to make informed decisions. Understanding HELOCs. A HELOC is a revolving line of credit secured by your home's equity. The difference between your property's market value and the outstanding mortgage balance or liens against the property. Unlike a lump sum home equity loan, a HELOC functions similarly to a credit card. You can borrow up to a predetermined limit, repay and borrow again as needed during the draw period. This flexibility makes an attractive option for expenses that occur over time. Key requirements for the HELOC approval. To qualify for a HELOC, lenders typically assess several factors. Home equity. Most lenders require you to have at least 15 to 20% equity in your home. Some will do it with even less equity. A credit score, a minimum FICO score of 680 is generally needed, though some lenders may have higher thresholds or lower thresholds. The debt to income ratio, we call it a DTI. Lenders prefer a DTI of 43% or lower, indicating you can manage additional debt responsibly. Income verification, proof of staple income through pay stubs, W-2s, or tax returns is essential to demonstrate repayment capability. Homeowners insurance. Lenders require adequate insurance coverage to protect the property's value, safeguarding their investment, their collateral. So what are the steps to secure a HELOC? Number one, assess your financial health. Review your credit card report and score, ensuring they meet the lender's criteria. Address any discrepancies and consider paying down existing debts to improve your debt-to-income ratio. Sometimes this can be done as part of the process as well. Research and compare lenders. Not all HELOCs are created equal. Compare interest rates, terms, fees, and repayment options from multiple lenders to find the best fit for your financial situation. And obviously, we do that for you at the Siegel Lending team at Geneva Financial. Number three, prepare necessary documentation. Gather essential documents, including proof of income, recent mortgage statements, identification, insurance details, homeowners insurance statements, to streamline the application process. Submit your application. Again, you can get that right on our mobile app, rsrlinks.com/mobile app. Complete the lender's application form, providing accurate and comprehensive information to facilitate a smooth underwriting process. Number five, undergo the underwriting process. The lender will evaluate your financial standing and may require a home appraisal to determine the property's current market value. Number six, close on your HELOC. Upon approval, you'll sign the necessary documents, finalize terms, and gain access to your line of credit. Ensure you understand the repayment schedule and any associated fees. So let's understand the HELOC phases. A HELOC comprises two main phases. It's the draw period, typically lasting 5 to 10 years, during which you can borrow funds as needed and often and make interest-only payments. Borrow the money, put it back. Borrow the money, put it back. Then you've got the repayment period. Following the draw period, this phase requires repayment of both principal and interest, usually over 10 to 20 years. So what are the pros and cons of the HELOC? The pros? Flexibility. Borrow only what you need, reducing unnecessary interest costs. Potential tax benefits. Interest may be tax deductible if used for home improvements. And again, talk to your tax advisor. We don't give tax advice on Ron Siegel Radio. Cons? Variable interest rates. Repayments can increase if interest rates rise, and the risk of foreclosure. Defaulting on payments can lead to losing your home as it's collateral for the loan. Strategic debt management with a certified liability as a certified liability advisor. That's a CLA. I specialize in helping families build wealth through strategic debt management. Understanding the intricacies of HELOCs and other financial instruments enables you to make informed decisions that align with your long-term financial goals and your short-term goals. By leveraging your home's equity wisely, you can fund essential expenses while maintaining financial stability. And remember, strategy beats rate always. If you're doing the two-step that we talked about, we don't want to use the home equity line of credit, because then when you use that and you go to do the second step, we're still considered a cash out loan. Just underwriting guidelines that most people don't follow. Final thoughts. Securing a HELOC can be a valuable tool for homeowners and first-time buyers aiming to manage expenses and invest in their future. By comprehending the requirements, processes, and potential risks, you can navigate the HELOC journey confidently. Remember, strategic debt management is key to building and sustaining wealth. That is the Borrow Smart segment, brought to you by rsrhomeselect.com, rsrhomeselect.com.